It does appear as though some strong hands are going in and buying a lot of the silver that's typically available in our trading markets in both London and here in the US.
Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics. And in today's show, we're going to be digging into some of the recent gold and silver inflows and outflows out of London and the COMEX and see if we can make some sense out of those. Fortunately, I am joined by one of the smarter people I am blessed to know, which is Rob Kientz of Gold Silver Pros. And Rob, it's been a while since we've had you on the show, so it's great to have you back. And how's everything going with you today?
Everything's going very well. It's been a good week. Still over 100 degrees here in Texas. That's not a lot of fun. But yeah, I mean, things are going well. And I think some big news is sort of bubbling up in the silver market. As to what it all means, really, I think we can speculate about that. But it does appear as though some strong hands are going in and buying a lot of the silver that's typically available in our trading markets in both London and here in the US.
Well, we will certainly dig into that. Although, real quick before we do, we're recording today, Tuesday, August 9th. This will be broadcast Wednesday, the 10th. And as you can see here, gold above 1800 again, which is nice to see. Silver above $20 at $20.50. Rob, by the time this is broadcast, we'll have another CPI report on Wednesday morning, which we'll see if there's been any dent in the government numbers, although with all of that said, any quick thoughts on the price action over the past couple months where saw quite a sell-off, gold hanging in there a little bit better, although both metals responding and rebounding a little bit over the past couple of weeks. So curious your thoughts on what we've seen in the past few months.
So here's kind of my view on it. I think if we look at it in the lens of just looking at that information and that occurrence in a single point in time, we may be missing its significance in the bigger picture. To me, and what I've said, and this is just my opinion, is I think that we're going through a big currency regime change. We're going through the end of the dominance of the United States, according to a lot of research I've looked at in past civilizations and looking at milestones and things. I think we're going through a bigger shift than just, the dollar's weak, gold and silver, and there's a lot of geopolitical risk, and gold and silver are going to go up. So and looking at that longer lens, it makes more sense to me what's going on in the market. So, for example, the typical narrative is, hey, we've got geopolitical issues. Why is gold and silver not spiking? Or the Fed is raising interest rates. Why is gold and silver not spiking? Or we've had an inverted 10-year, 2-year bond yield curve. Why is gold and silver not spiking? Because if you look at the bigger picture, I think what is happening is there is this broad liquidation across asset markets, and gold and silver spot prices are determined by the paper trade predominantly. They can be affected by physical, but 99% of the time it's paper pricing mechanism. And those markets will sell off too. People will sell positions to move money about. And so we've had a sideways price in gold and silver. We also have to remember that it's not the season for gold and silver. The summer is sell in May and go away. And that's no more true in any market than it is gold and silver. It's a very typical pattern. Now, we do get people coming back into the market in the fall. We'll get the gold in the Indian love trade where they're buying jewelry for gifts and for dowries and things like that. That tends to bid gold and silver up. And if we just look at that cycle that I just explained what it is, then it kind of makes sense. But if you look at the broader picture and say, as the potential debt contagion worsens and people are positioning themselves for what I think government officials and central bank officials know is going to be a rather lengthy and difficult recession, in which they're also going to be introducing some new monetary and policy tools, then I think you look at gold and silver as, hey, the market's repositioning. I don't even think they're focusing on gold and silver yet. I think the powers that be are focused on keeping the Titanic from going down. And whatever they got to sell and move around, they're going to sell and move around. And I think this is a bit of a different animal than we would look at in typical markets. What I do is I try to dig into the data and figure out what's going on. And we do have a lack of fineness to data that I would like to see as a former auditor. We have a lack of availability and transparency sometimes, and we question, how did they get this number? So we can't make concrete statements, but it appears from what I'm seeing, a lot of big hands are buying gold and silver. They're coming through the retail brokers. Andy Shakeman from Miles Franklin talked about this customer from Texas, a billionaire that bought $50 million worth, 900,000 silver eagles and the rest in gold. And Andy did not say who that was. He kept his, client information private, but I've talked to several other people in the industry who have connections to brokers who would know and are in the business. And they say it was, the Walton family. So if the Waltons that own Walmart are buying $50 million in precious metals, that's an indicator to me that people are getting pretty serious about it. So I think underlying the derivative markets, there's a lot of buying and there's a lot of positioning. And lastly, I'll make the point, the bullion banks, specifically with silver, but it's happening to a lesser extent with gold. The bullion banks have dumped tremendous amounts of short silver paper to the point that they went net long. And not only they go net long, they went really net long. And I talked to guys who've been involved in this market for years. I've talked to Bill Murphy of Gata. I've talked to Dave of Investment Research Dynamics. You have him on the program all the time. I've talked to a lot of other people behind the scenes, and they're like, I've never seen the bullion banks flip like this unless we're about to have a bull market. It's just so they position themselves to go long in the silver paper markets, and the managed money's taking the other side. And while they haven't gone net long in gold, they've been dumping gold shorts. So it looks like they're positioning in gold. I don't know how far they're going to go. We have to see. It's going to take a long time for them to wind down their short position in gold, much longer than it did silver. But it looks as though they're changing their opinion on how short they should be in gold. Now, whatever their models are as to how short they want to be, when the contracts are opened, where they're positioning in, that gets into a lot of data that we don't have. But we can just look at the aggregate trade, and we know that people had traditionally been paper short who we consider savvy and knowing where the price is going to go are now going along. And the metal trade's going bonkers in terms of retail's getting bought up. We had a $3 million order come in through Arc Silver that came through my network. It was somebody that watches our show, bought $3 million of metal within the last week. And we're starting to see bigger and bigger sales. We're starting to see those bullion sales scale up. At the same time, you're starting to see people reposition in those derivative markets. Now, it's early stage. We don't know whether that's a temporary reposition, whether that's a long-term trend, but the way that it flipped, especially in silver, bullion banks and the managed money just literally flipping sides like that over a period of 3 to 4 weeks, that's a pretty astounding. So something's going on underlying the betting that's going on in silver specifically, but also gold. And it'll be interesting to kind of watch it going forward to see how far that goes. Is that telling us we're in the next leg of the bull market, or is it like a temporary deal for some reason, for some other reason? We don't really know.
Well, there's several interesting points you mentioned there because back to the COT report, we're seeing that the COMEX price still tracking what the banks are doing for the most part, because it really did rebound as they were getting less short, or in silver even slightly net long. And then we've seen that rally over the past week or so, versus seems to be a different tone in the physical market. So a lot of interesting dynamics there. And I wonder if to some degree that Wall Street, I don't think they see this the same as you or I, where the Fed's raising interest rates, but maybe we'll have a recession, but things under control. Whereas from an Austrian economics point of view, you wonder, are we closer to seeing things get out of control? From the time I got into this, I've watched the debt loads skyrocket, and you don't even see any intent to address that. I know there's the Inflation Reduction Act that says they're going to save a couple $100 billion by the year 2050, which leaves me less than feeling optimistic. So interesting to see the different perspectives on those two markets, and we'll see how that goes. Although, Rob, I know you wanted to talk about the London silver holdings, which Ronan Manley did have that great article where he showed that you've seen a decline, especially since November. And we actually got the latest numbers out about a day or two ago. We saw it go from 997 million ounces down to 950 million ounces in the July numbers. So what do you think is happening there?
Well, Ronan had a really good article about it, and he's really the guy that probably covers that market the best. I know Alistair does as well, and other people do, but his article content's great in explaining what's going on, and it's free, and it's a way that everybody can understand. So I fully encourage people to go out to the website. I believe it's bullionstar.com. Look for Ronan. You'll find it in the search, or just Google him. But what it means here is on the London market. If you remember back, Chris, last year there was a silver squeeze, late January, early February. People bought a bunch of SLB shares. And so most of the metal for most of the ETFs that supports the ETF trade is in the London market. And something like wasn't 110, 109 million ounces of silver got pulled off of the free stockpile that supports that market. And the LBMA came out later, a few months later, and had that report we had on our show. I think you had on your show where they talked about if we had gone on for another week or two, we would have been bankrupt of free silver. So we knew that was basically an admission at that point that they had more paper trading on top of their actual available metal. And we knew that already, but also we knew that if one big push came in, you could probably squeeze out that market, at least temporarily, because it would take a while to get enough silver to get back and recapitalize that. You'd have to go to, I mean, you would have to go to the miners, you have to go to the refiners, you have to squeeze inventory out of various mints that may have something. It would take a while. So they were really close to that market capitulating, and it didn't get there. But what I've seen since then is there has been a general move to take physical off the market. Certainly in that chart you showed on the London markets, you're starting to see it come off. We've seen it start to come off on silver and COMEX. The overall inventories of silver have fallen on the COMEX, but what's in particular interesting, and something that I predicted about a year and a half ago that would happen, and it has been happening, is the registered inventory at COMEX, which is what actually goes to trade. It's not private storage, not privately owned. People are putting it up and saying, okay, this is for trade, this is for settlement. You know, that's fallen 2/3, I think, in the last, we'll call it a year and a half. So about the time that we had silver squeeze movement, a couple of months later, people started really pulling down the inventories of silver on COMEX. And in the last 7-8 months, they've been doing it in London. So somebody or a collection of somebody's is going to get their physical. I think Ronan speculated it could be a lot of industrial demand, because if you remember back to what the Silver Institute predicted back last November, they thought we would have a current shortage of about 100 million plus ounces this year between mine output and demand. So it makes sense that inventories are coming down. Now, the question is it all industrial demand? Or do you have people starting to buy it for other reasons? Are people buying silver because they're trying to protect themselves from currency debasement or a financial reset? Or what they see is weakening fundamentals on all the rest of the markets. You know, if the stock market's going to continue to weaken, if Bitcoin's going to trade sideways, maybe people are interested, you know, getting into silver and looking at the long-term dynamics of that trade. You know, so we don't know, but we just know the inventories are coming off, and it's big. It's a big amount of inventory withdrawal that started here in America, and now it's gone overseas. And so it'd be interesting just to watch that and see what happens.
Yeah, and I'll pull up the Silver Institute, which comes from Metals Focus. You can see last year, 51 million ounce deficit. If you put in the ETPs, which if they're including metal in there, takes it to 116 deficit. If you include the ETPs or ETFs the year before, actually the 2 years before, you'd have 3 years of a deficit. And I actually asked Michael D'Arienzo of the Silver Institute of where that's coming from. I've asked a bunch of people where it's coming from. Some have suggested that it could be coming from the investment grade stockpiles. And like you pointed out,
Yeah.
we have seen the reduction here in COMEX. It's interesting, again, here, the ETFs. We see the metal coming out, but it's not as if it's going out of one and coming into the other here, similar with the London holdings. We see metal coming out. So whether that's filling, I know Indian demand has been strong lately, or just industrial demand, I think would make sense. Although, again, we're speculating because it's hard to know without having official data points on where these things are going. Although, Rob, one question I had for you here on the COMEX, I agree with what you said, and it's interesting that we've seen metal leave. There's about a third left from what was there in the registered stockpile. Although, I suppose, in all fairness, we could take a look at some of these previous data points where, interestingly enough, here in 2008, right before silver goes from 21 to 9, you know, we saw a big jump in, and here about 90 million ounces gets down to about 30 million ounces, while silver is spiking to $50. Although, what do you make of that, where we've seen similar things before and even lower levels of metal before? So how do you put that into context?
So I think it helps to look at, like I said, at the overall bigger picture. So why would somebody be motivated to to stockpile COMEX with silver. Why are there stockpiles there? If you go back to some of Ronan's research, he's intimated in his works many, many times that the COMEX and the London markets are collusive together in terms of them actually sharing metal in other ways. So you've got the EOP, which is a way that you can arbitrage the prices across markets. You've got the 400 ounce, good LBMA bar, good London bar contract, which doesn't get used much. But he also documented in one of his articles how the flows, which usually goes gold flow from US to the UK, reversed in 2020, I believe. So people can go look at his article history. I don't want to give too many details. I don't want to misquote, but there was a reversal. So there was at some point in time a funding or a movement, bailout, whatever you want to call it, from other markets to the COMEX. And then we saw those inventories spike. But now a little bit of difference is you're starting to see the inventories come down sort of everywhere. And so, and if we go back to Perth Mint, so let's bring Perth Mint back in. I mean, guys know last year and early this year, Daniel and I did a 4 or 5 part series on the Perth Mint where we took their published financial statements and rebuilt their balance sheet from it. And he's a CFA, I'm a former auditor. So putting our heads together, we did a spreadsheet, built it out. There's a lot of back and forth. Their CEO went on Kitco and basically was having to answer to it. We know it was from us because we're the only one talking about it at the time. And they were referencing exactly what we said. And then we came back and relooked at their financial statements the next year, and we figured out what the scheme was in a nutshell. So in a nutshell, Perth Mint had 929 million Aussie dollars worth of metal that customers had paid for that was not on their that was not in their physical stock. And in one of the interviews with Kitco, their CEO, Richard, intimated that they do facilitate metal flows to an outside party. They did in that case, and it was an S&P counterparty. So we knew that it limited it down to a few entities, a bullion bank size, a really big company exchange, something like that. And so Australia, the Perth Mint was feeding a lot of metal at this time. We're talking 2020 financial statement where we saw this. They were feeding it into the general market. Now, was that go to COMEX? Did that go somewhere else? We don't know. But they got called out on it, had to reverse their position. Part of the scheme was metal in a pooled account. Part of it was in an ETF. They sold that ETF to Goldman Sachs. Goldman Sachs immediately said, you cannot redeem for metal. Now, does that ETF have the metal? Did it get recapitalized back into, the ETF that Goldman out? I don't know. But I just know that that was really squirrely, and that was going on about the same time that we saw that reversal of flows that recapitalized COMEX. But now, whether you look at the London and the COMEX markets, the metal is coming off. Silver especially. Gold is a little bit different story. But the silver is coming off. Again, at the same time on the COMEX, you're seeing a repositioning of the bullion banks and the managed money. So again, you start to put all that together, it's like something's happening. Does that mean we're going to have another silver squeeze on silver? I don't know. I just know it's real interesting. I mean, these entities are completely reshaping the way that they've traded silver since back when I started studying 13 years ago. So something's going on. More metals come off the Western markets. We still got metal there. But why? Why the flows from the UK and from the Perth Mint into these coffers? And then why the flows back out and who? And we'll never know because they're never going to give us the transactional data. I complain about this on my show all the time. We don't know who's taking it. We have some idea of some of the parties that gave some of it up. We don't know them all. We don't know all who's taken it. We just don't have the data. But it's clear that it has been a big shift, not only in the way that people are positioned in the paper markets, but in the way the metals have come off, the physical metals have come off. And we just have, all I can say is you're just going to have to follow that and see if they can get bailed out again, or if this time we're in a squeeze where there's not a big mint like Perth or somebody else that can supply that silver. And so it's going to take a while. It's not going to happen overnight, but that's an interesting thing to see because the dynamics of that market have really changed. And I don't know. From what I see, somebody's getting that silver and gold and eventually gold off the market as well. And for what purpose? That's the fun part. That's what we speculate. We don't know why.
Well, I think people are rightly concerned about some of the things they've seen over the past couple of years, although mix in that now the Fed is hiking interest rates, and perhaps that's the last question for you. How do you see this playing out? Let's say we go a year or 2 or 3 ahead in the future. I'm of the school of thought that at least for the moment, it seems to me the Fed is serious about hiking rates, and I guess rightfully so. We're seeing massive inflation everywhere to the point where you can't just call it transitory anymore. So it makes sense that they would be wanting to keep this in check. We'll see how far interest rates go before you have more turmoil in the market. Certainly, I don't think the mortgage market is collapsing yet. We're seeing signs of slowdown. How do you see this all playing out? And is it whenever the Fed starts printing again that's when you think perhaps you run into an issue with the metals, or how would you phrase that?
Yeah, I would say we did a really good show with this with David Hunter, who's very big on Twitter, been doing a news service for many, many years, talking about the stages. And if you go back to Austrian economics, which you mentioned, Chris, there could be like a deflationary event, some sort of melt up. We all kind of know how the end game scenario is playing out. And so far, what we've seen is kind of following along that Austrian economist view on the way this all might kind of end and transition into some new system. As far as the economy goes, not just the mortgage market, excuse me, the real estate market is starting to roll over. I know a lot of real estate agents, and I just sold some land. I did this on purpose. I liquidated my land, hopefully near the top, somewhere, it doesn't matter, to get liquid, to have some cash and precious metals, what I think are going to be buying opportunities going forward. But my real estate agent is like, you hit it just right, because the data on all the land around here is going down. And I've talked to so many people that say, yeah, because interest rates are going up and we had really high housing prices to begin with,
Right.
those prices are coming down. They have to allow new buyers into the market. So inventories are starting to expand a little bit. So you're starting to kind of see a little bit of rollover in real estate. It hasn't really decelerated, but you can kind of see it in the numbers. And all the real estate agents, and I'm involved in a bunch of real estate groups down here, because my very first investment wasn't gold, silver, it was real estate. So I still go to weekly events in real estate, and everybody's talking about it. The main thing, I'm in a group of apartment investors. The main thing that they're definitely afraid of is rising interest rates, because it increases your loan to value. And in commercial real estate, that kills your cap rate or your multiple, which basically means it takes right off the top what you're going to get when you sell the property. And when you're in real estate, you make money at the beginning. You make money when you make the deal, not at the end. And if your assumptions are wrong, that's going to affect your return. And they're definitely afraid of it. And it is the talk of the local, residential apartment market. And of course, we already seen the retail commercial already collapse. That's been collapsing for a few years. COVID really helped that out, but it was coming under pressure before that. A lot of the REIT writers on Seeking Alpha were talking about it. The amount of people renting shopping malls had gone down. So real estate's under pressure. But ultimately, I think what's happening is you do have runaway inflation. If you look at the PPI numbers, they're in the double digits. So we expect the CPI, or what the consumers will pay, because the PPI is producers. So producers are going to make something, their prices are going up. They have to pass on consumers eventually, or they go out of business. So the consumer, you would suspect that the PPI is a leading indicator for what the consumer is eventually going to pay. So that tells me CPI is probably still going to go up. Whether it accelerates, decelerates, I don't know. But I've called for double-digit CPI this year. I think we'll get it at some point, or really, really close to it. And that puts tremendous pressure on the economy, because 72% of the economy is wage earners, and their wages are not keeping up with inflation. And eventually something's got to break, right? And the Fed has to tighten, because what they have to stave off is what they're trying to stave off is a collapse. It won't work, but they're going to tighten as much as they can. I found it interesting. Last thing I'll say, so I don't go too long here. I found it interesting. I did a separate video on this last week. When the employment numbers came out, the U6 number everybody likes to talk about, it only accounts for people that haven't been unemployed for longer than a year. And after a year, they start to roll these people off, the long-term unemployeds, what I call structurally unemployed, because the structure of the economy can't make enough jobs for them. So after a year, the government just says, we're tired of you guys. We only want to look at what's going on right now. So when you go to the news, CNBC, Bloomberg, whatever, and you get that unemployment number at 3.3 or 4, whatever it is, all that's talking about is a percentage of people that have been unemployed less than a year. It does not talk about the long-term unemployed. When you look at labor force participation rate, we're at 62.4%. That's 3 percentage points lower, Chris, than where we were prior to the last recession, 2008, 2009. So all the money printed over the last 13 years has seen a lowering in overall labor force participation rate of 3%. Now tell me how we have a recovery when you have 3% less people even having jobs. And if you look at the latest report from the BLS on the non-farm payrolls, there's a sneaky thing in there that they don't like to point out, where more people have 2 jobs, and then we think they're being double counted in the numbers. So more people have 2 full-time jobs, but less overall people are working, and that leads to a lower unemployment number. And I think the way that the government's accounting for that's really squirrely. And the reason we know that is there's two surveys in the non-farm payrolls. There's the household survey, which is what I consider real, because you're going to households and they're telling you what's happening on the front line every day. And then they have the other one, which is basically they do surveys, and then whatever people answer on the survey, and the U6 number comes from that one, and it's the least accurate. And so I think that there's a lot of fudging in the numbers and a lot of misrepresentation. I think employment's much worse. We know that the wage rates are much worse than inflation. So we're in a period in which it's going to be stagflation, but I think eventually it becomes a deflationary issue, because we're so debt laden that I don't see the consumer or even the corporates getting us out of this before you have a big debt restructuring. To me, that says crash. That's what I believe. But of course, everybody's, they can interpret the data the way that they wish.
Well, and looks like we have more interest rate hikes coming. Latest seems to be that leaning towards 75 basis points in September, which not making things any easier. Although, Rob, I sure appreciate everything you've shared here today. And could you just let folks know where they can find you and your great research?
Yeah, just come visit us, Gold Silver Pros. We're on YouTube, Twitter, and you can visit our website, goldsilverpros.com. And eventually, I keep saying I'm going to do TikTok. I promise sometime this year, I'm going to put out a video. So you may get us over there as well.
Well, great to catch up with you as always. Probably been too long since we've done this, but sure appreciate that. And we'll look forward to catch up again soon.
Yeah, I love being on our show, Chris. It's an honor. Thank you.
Well, thank you, Rob. Always great to catch up with you, and certainly a lot of interesting movement going in and out of those vaults. We'll keep an eye on that for you going forward. Hope you're having a great day at home. And one last thank you to Sierra Madre Gold and Silver, who brought us tonight's video. And as you can see here, they have 3 projects they're moving forward. Their project in Tepic and La Tigra, as well as the La Gatera silver gold mine, which they recently purchased from First Majestic Gold and Silver, helping them get to their target goal of 50 to 100 million ounces in the ground and headed towards production in the next 2 to 3 years. You can find out a little bit more about Sierra Madre at sierramadregoldandsilver.com. And with that said, hope you're having a great day out there, and I'll see you again tomorrow.